Hi, my name is Nalini and I work in the Economic Research Department at the Reserve Bank of Australia. This video provides a brief summary of current economic conditions as published in our February Statement of Monetary Policy. Let's get started by looking at the global economy. Global economic activity had been strong prior to the recent Omicron outbreaks. This reflects widespread easing of activity restrictions enabled by increases in vaccination coverage. We can see how the economic recovery has been progressing for selected countries in this graph, which compares the level of GDP to where it was in the December quarter of 2019, or pre-COVID. The grey circles show the change up to the June quarter 2021, and the red triangles show the change up to the December quarter 2021. Where the latest data are not yet available, the chart shows a forecast, which is the case for Australia. Most advanced economies are now at or above their pre-pandemic level of GDP. This is shown by the red triangle being positioned above the zero axis. GDP in Taiwan, Norway and Australia is furthest above its pre-pandemic level. The recovery in emerging economies has been more uneven. Turkey, China and Vietnam are well above their pre-COVID level of GDP. In contrast, South Africa, the Philippines and Thailand have a lower GDP than they did prior to the start of the pandemic. Most economies grew strongly in the second half of 2021, which is represented by the graph by the red arrow sitting above the grey circles. In this graph, we can see that India has had the strongest growth from the fact that it has the longest red arrow. The emergence of the Omicron variant, however, has led to a very sharp increase in COVID cases globally in recent months. Despite this, deaths and hospitalizations have remained relatively low to date relative to previous waves. This is because Omicron infections appear to be less severe, in part thanks to the protection provided by vaccines. As such, while the Omicron wave will cause some disruption to the global economic recovery, it is not expected to have a large or sustained effect on economic activity. In Australia, timely data suggests that the emergence of the Omicron variant began to affect population mobility, that is, how much people move around the community for activities like exercising, socialising and work towards the end of 2021. It is expected that the decrease in mobility will be associated with a fall in consumer spending, particularly in the hospitality and tourism sectors. Turning now to the outlook for the economic activity in Australia. The purple line on this chart shows how GDP has evolved relative to RBA's expectations at the February 2020 SMP, which is shown in grey. That is, what the RBA expected prior to the pandemic. The pink line shows how the RBA expects GDP to evolve over the next few years or over the forecast period. There was a sharp dip in GDP during the September quarter because a large share of the population was in lockdown during the Delta outbreak. This pushed Australia's GDP back down to its pre-COVID level. However, we expect GDP to recover rapidly in the December quarter, in line with the lifting of the Delta lockdown restrictions. Looking further ahead, growth will slow in the first part of 2022 as a result of the Omicron wave. This reflects the fact that with so many people isolating, business operations have been disrupted by worker shortages. Consumers are also displaying greater precautionary behaviour due to health considerations. As mentioned earlier, the impact of the Omicron outbreak is expected to be short-lived. The recovery is expected to pick up once again in the rest of 2022, with recent strength in labour income and household wealth boosting household consumption. Business investment and spending by state and federal governments should also support demand. Growth is expected to moderate a little further out. Now let's take a closer look at household consumption, which is the largest component of GDP, accounting for around half of the spending in the Australian economy. Household consumption decreased by nearly 5% in the September quarter. This was because of the Delta outbreak and associated lockdowns. We expect consumption to rebound strongly in December quarter, consistent with the lifting of activity restrictions that were in place during the Delta outbreak. In response to the spread of Omicron, however, the recovery is expected to slow in the near term because of precautionary behaviour and subdued spending on discretionary goods and services, like dining out, cafes and restaurants. Looking further ahead, growth in household income, household net wealth, and reduced uncertainty are all expected to provide support to household spending over the next few years. Now turning to the labour market. Employment in New South Wales and Victoria, the states most affected by the lockdowns during the Delta outbreak, is shown in the top panel in green and blue lines. By the end of 2021, employment in New South Wales and Victoria had recovered to around the levels observed just prior to the Delta outbreak. Similarly, there was a snapback in hours worked, shown in the bottom panel. The recovery was strongest in contact-intensive industries like accommodation and food, and arts and recreation. In the rest of the country, employment and hours worked were relatively stable during the Delta wave, shown in the yellow line. Looking forward, we expect that the spread of the Omicron will temporarily disrupt the labour market. We expect most of the effect to be in hours worked, as employers take time off for illnesses or because they are required to isolate. Now, despite these recent disruptions, demand for workers from firms remains strong. A useful indicator of labour demand in the economy is the number of vacancies that businesses are trying to fill. On this graph, vacancies are shown as the percentage of the labour force to make sure that comparisons over time are not affected by a growing population. We can see that the number of vacant jobs has increased sharply in recent months and is currently at a record high level. This is consistent with the fact that in surveys, businesses have been reporting difficulties in finding suitable workers for a range of roles, including in the construction, professional services, agricultural and hospitality sectors. Reflecting the strong demand for workers and the high vacancy rate, the unemployment rate fell to 4.2% in December, which is the lowest rate since August 2008. Looking ahead, labour market conditions are expected to be strong over the next few years. Employment is forecast to grow strongly over the remainder of this year, before moderating somewhat in 2023, in line with a slower expected growth in GDP. Meanwhile, the participation rate, which captures the share of the population either working or actively searching for work, is forecast to be at very high levels. Overall, strong labour market conditions are expected to drive the unemployment rate even lower to around 3.75% by the end of the year, and then edge a little lower after that. Turning to wages. Wages growth has picked up, but it's only just above the low levels seen prior to the pandemic. The Wage Price Index, or WPI, which measures changes in the base wages of workers, increased by 2.2% over the year to September. A further pickup in wages growth is expected as the labour market tightens and spare capacity is absorbed. However, we think the increase will be gradual because of multi-year enterprise agreements, the review of award wages that takes place on an annual basis, and public sector wages policy. While the pickup in wages growth is expected to be gradual, wages growth is expected to be 3.25% by mid-2024. This would be the fastest pace since 2012 and consistent with the anticipated very low unemployment rate. Moving on to inflation. Headline inflation, which is shown in purple, was 3.5% over the year to the December quarter. Headline inflation in the December quarter was boosted by three factors. First, higher petrol prices due to high global oil prices. Second, higher input costs for housing construction, such as for timber and steel, coupled with strong demand for new housing. Third, higher prices for consumer durables like clothing and cars, which have been boosted by ongoing supply chain disruptions, sustained global and domestic demand, and higher shipping costs. Together, these three factors account for around 2/3 of the increase in the headline CPI in the December quarter. An alternative measure of price pressures in the economy is underlying or trimmed mean inflation, which trims away some of the larger movements in prices. This is shown in blue. This measure of inflation rose to 2.6% over the year to December and is now at its highest level since 2014. Underlying inflation is expected to increase further in the near term, peaking at around 3.25% in mid-2022, before easing as international and domestic supply chain pressures subside. Further out, the tightening labour market and stronger associated wage growth is expected to maintain underlying inflation in the top half of the 2 to 3% target range. Now, the policy measures introduced by the Reserve Bank in response to the pandemic have continued to support the economy. The current policy package includes a record low cash rate target and low-cost term funding for the banking system. The stock of bonds purchased to date is also continuing to support lower funding costs. However, a substantial change since our last update is that the board has decided to end its quantity target for asset purchases. This decision was based on 3 criteria. First, the actions and plans of other central banks, many of whom have entered or will soon enter their own asset purchase programs. Second, to ensure the smooth functioning of the Australian bond market. And third, and most importantly, faster than expected progress has been made towards the bank's policy goals of full employment and inflation within the target range of 2 to 3%. The board is committed to maintaining highly supportive monetary conditions to achieve its objectives of a return to full employment and inflation consistent with the target. Ending the quantity target for asset purchases does not imply a near-term increase in interest rates. Rather, the board will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. Underlying inflation has just reached the midpoint of the target range for the first time in over 7 years. Consequently, the board is prepared to be patient as it monitors how the various factors affecting inflation in Australia evolve. And that's a wrap on our summary of the February Statement of Monetary Policy. The link to the statement can be found below. Thanks for watching this update. Feel free to explore our website for more information, including some video explainers about key economic issues. Thank you.